Hi, welcome to Let's Talk Bond, the bond market podcast from INR Bonds. I'm Arjun Parthasarathy, and in this podcast, we are going to talk about the current happenings in the market, which is namely credit stress, which is apparent, and the RBI policy coming next week. What could it mean to the markets? And also the new US elections getting over. What could be the policies of the US government that is playing on global markets' minds? Just before we start, I would like to highlight some of the risks in investing in bonds. One is interest rate risk, where prices can go up and down. The second is credit risk, where there could be defaults. And the third is liquidity risk, where the cost of buying and selling could be high. Also, INR Bonds is hosting a webinar on India credit down cycle and its impact on markets. This webinar has very renowned panelists, and we will be taking you through what is happening in the credit markets in India and how it could impact the overall markets and also your investments as well, because you would be invested in various asset classes. This webinar is on Thursday, the 5th of December at 3 p.m. Please log in, please register for the webinar by going to the descriptions in the description box below and click on the link to register. Now back to the podcast and the topics. Credit stress, yes, I mean, it is becoming more and more apparent. In the last 1 month, we have seen two companies, one home finance company based out of Delhi, communicating on a default, and a microfinance company where the auditors have sounded out that the company does not have any liquidity and it needs to raise capital immediately to allay concerns. Credit rating agencies have also been advised to take in cognizance any corporate events in assigning ratings to the bonds to the issuer. And while credit rating agencies have always been a little lag, the regulators are now telling them to be more proactive in their ratings approach. All this is also being felt in equity prices of most of the lenders. Prices are down sharply for many of them. They had touched peaks just about 6 months to a year back, and in the last 1 year, there's been a continuous decline in prices, which again shows that the market is not giving a higher valuation. So the market is actually revaluing lenders at lower levels, and that is also impacting investors holding equity of lenders. Also, bond prices for investors holding bonds of lenders that are facing issues are seeing prices actually go down, that is, yields are going up. And this could actually lead to more and more risk aversion amongst the investor class and the market as a whole. And the risk premium on bonds are rising and could rise further if this trend continues. So in this scenario, what will be the RBI be looking at? Now, RBI is coming out with its December policy next week, and the policy statement will be released on the 6th of December, which is Friday. And in the policy statement, markets will be keenly watching for what the RBI believes. Clearly, if there is a slowdown in the economy, and if the lenders are facing issues, and because the borrowers are not able to service their borrowings, then RBI may feel that the interest rates are too high and it's time to reduce the interest rates. But at the same time, they would have to worry about many other things that are happening. One is that Indian rupee is falling sharply. Inflation is also above RBI's target rate due to various factors. And the third is also portfolio flows that have been very robust in the last financial year. In this year, have seen very sharp outflows in both of by foreign portfolio investors, and all this is impacting the rupee as well. India's foreign exchange reserves have actually come down from highs of close $700 billion to about $650 billion, which shows that RBI has been selling dollars to protect the rupee. But whether this can continue, and if they do that, then when RBI sells dollars, liquidity actually starts to go into deficit in the system. And again, we are seeing liquidity in the system going down from a surplus of over 2 lakh crores to a deficit of around rupees 10,000 to 30,000 crores. But this could increase if there is further outflows and RBI continues to sell dollars to protect the Indian rupee against weakening further. So the RBI has a tight balancing act to do. One is to ease the cost of borrowing for so that the borrowers can. One is that they can uh, repay loans that they have taken. The second is that also to increase consumption in the economy, but also at the same time, they need to be aware of the risks to various other factors, including global factors, and also make sure that the market is protected against any financial sector instability due to a strong credit stress in the economy. And all this is also now being exacerbated by the by Fed policies, and also with the U.S. elections voting in the Republican Party, where one of the stated aim is to increase the fiscal to spend, and second is to also impose tariffs on other economies. This is adding to a lot of risk aversion, especially on inflation. And the Fed too has sounded out that the U.S. fiscal should be contained rather than increased. Then it's the first time actually I have seen them talking about fiscal directly in most of their uh, policy actions to boost the economy. They have normally said that the government should spend to boost the economy, not cut down on fiscal. But this time, they are very clearly saying that the debt is too high. But having said that, the dollar is still very strong, and the rupee is tending to weaken. And with all this tariff talks and others, there is risk aversion that is happening, and all this is putting pressure on global capital flows as well. So a lot of things are happening, and investors obviously are concerned because they would be invested in both equities and bonds as part of their savings, and all their investments. What is the outlook for their investment? How do they reposition? What do they do? Rebalance? How do they hedge? All these thoughts they would be asking themselves or their financial advisors, and they should be aware of all these risks before investing. So clearly, a lot of events happening in the financial markets that cannot be ignored, and it's not a one-way street. So there are going to be ups and downs. The question is how long will the down cycle last, and many other things. And all this will be for available. All this investors can come and ask questions to an expert panel on the podcast, on the webinar that we are having on India credit down cycle and its impact on markets. Remember, Thursday, 5th December, 3 p.m. You can register for the webinar by going to the description box below and registering and clicking on the link to register. Thank you very much for listening in, and do follow us on all podcast channels, including YouTube, Spotify, Apple Podcast, and